Welcome back to Investing Talk Podcast. We're here to take your sources, your questions, and really pull out the most important nuggets of knowledge and insight. We want to give you that shortcut to being truly well-informed. Today, we're digging into a question that I know is on a lot of your minds, especially if you're watching the AI space. Is BigBear.ai a good time to buy now? We've got a whole stack of analysis here, everything from their core financials to the latest technical signals, and we're going to try and unpack it all for you.
Indeed, and this is a really classic example of needing to look beyond just the headlines, isn't it? To really understand what's actually driving a company's performance and its potential down the road. We'll be breaking down BigBear.ai's financial health, their specific market position, and of course the recent stock movements to help you get a clear picture of the whole landscape.
Right. And before we really jump in, if you find these analyses helpful, please do remember to subscribe, like, and maybe drop a comment on this episode. Your engagement honestly helps us reach more people like you. And hey, if there's a specific company you'd like us to investigate for a future session, just leave it in the comments below. We genuinely love getting your suggestions. Maybe even consider buying us a coffee if you feel like it, links in the description. Okay, let's get into it. The core tension here is fascinating, isn't it? BigBear.ai, they've been reporting pretty significant losses, yet you look at the analysts and many are shouting, strong buy. How do we square that circle? We're going to pull apart the data and try to understand the story behind what seems like a contradiction. Okay, let's start with the basics then. For anyone who might not be super familiar, what exactly is BigBear.ai? What do they do?
Sure, so BigBear.ai provides AI-powered solutions, and their main focus primarily is on U.S. defense and intelligence agencies. They do also operate in some other sectors like supply chain management and digital identity solutions as well. So when we talk about their market, it's quite specific. You could say it's a strategically important niche. They're not just, selling general AI off the shelf. They're tailoring it for very specialized, very critical applications.
That focus on defense and intelligence, that immediately makes him curious about the money side. How's their financial picture looking? Let's start with revenue. How's the top line?
Well, the revenue did see some growth. It was fairly modest, though, about 1.98% in 2024, reaching $158.24 million. So while it is growth, and any growth is generally good, it's certainly not the kind of dramatic leap you sometimes see with high-flying tech stocks. It suggests maybe a steady, but perhaps not explosive, expansion of their sales.
Okay, modest revenue growth. Got it. What about the bottom line then? Are they actually turning that revenue into profit?
This is where we hit a pretty significant challenge. BigBear.ai has reported substantial losses. We're looking at a net income of negative $229.74 million over the trailing 12 months, the TTM. And looking at the TTM, that most recent 12-month period, it clearly shows they're operating at a really significant loss, negative profit margins. Simply put, right now, they are not profitable.
Wow, negative $230 million TTM. That definitely sounds like a red flag. What does that imply about, say, their debt levels or just their general cash flow situation?
Yeah, you're absolutely right to connect those dots. While the sources we looked at didn't give us the exact debt numbers, a consistent negative net income like that, it points directly to potential difficulties with cash flow. I mean, if a company isn't bringing in enough cash to cover its costs, its operations, its research, it typically has to rely on external money.
Right.
That usually means either taking on more debt or issuing new shares, selling more stock. Both of those routes can create headaches for existing investors, either a bigger debt load for the company or your own shares getting diluted. It definitely suggests they're burning through cash to keep things running and fund development.
Okay, so on one hand, we've got this picture. Modest revenue growth, yes, but also these really significant losses. Yet, despite these financial, hurdles, the analyst consensus is a strong buy. That still feels like a bit of a paradox. What's driving that optimism?
It is fascinating, isn't it? And I think what helps unravel that paradox is understanding why they're saying strong buy. It doesn't seem to be based on the current profitability at all. Instead, it really looks like a strong bet on their future, on their growth potential, specifically within that AI sector, and particularly focused on national security. Analysts are likely looking at their unique position, dealing with what are often very sticky, long-term government contracts, sometimes classified projects. These aren't just quick sales. They often involve deep integration, high barriers for competitors to even enter.
Right, it's harder for someone else to just jump in.
Exactly. So it suggests a belief that even though profits are negative now, their future revenue could be quite resilient. maybe even expanding within this critical defense area. They're basically betting that this strategic positioning, this niche, will eventually translate into strong financial performance down the line.
That definitely makes sense, especially given that niche focus. But how strong is that niche? I mean, thinking about competition, could being so specialized also be a risk, a limitation?
Well, it's kind of a double-edged sword, isn't it?
Mhm.
Operating in such a specific area, especially AI, for national security and supply chain, that could be a huge competitive advantage. It means they've likely built up expertise, relationships, maybe security clearances that are really hard for more general tech companies to just replicate overnight. Gives them an edge there.
Okay.
However, you raise a really excellent point about limitations. The broader AI market is just incredibly competitive. You've got giants, you've got agile startups, everyone's piling in. So while BigBear.ai might dominate its corner right now, maintaining that edge requires constant innovation. And they'll likely need to scale beyond just government contracts eventually. Plus, that heavy dependence on U.S. government spending, that introduces a whole unique layer of risk,
Budget changes, policy shifts.
Exactly. Any shifts in defense budgets, political priorities changing, even just the slowness of government procurement cycles.
Hmm.
All of that could directly hit their revenue.
Yeah.
Makes them more sensitive to, well, the whims of Washington, D.C. than many other tech firms.
Okay, so we've kind of mapped out the financial landscape, modest growth, big losses, and this analyst optimism that seems rooted in the future potential and that specific niche. Which brings us to a really crucial question. How do you even start to value a company that isn't making money? Let's talk about how the market tries to put a price tag on this.
That is precisely the challenge. Your traditional valuation tools, like the price-to-earnings ratio, the PE ratio, well, they're useless here because there are no earnings.
Right, no earnings.
But we can look at something like the price-to-sales ratio, the PS ratio. And for BigBear.ai, that's sitting around 14.49.
14.49. What does a PS ratio like that, 14.49, actually tell us about how the market sees BigBear.ai?
Well, a PS of nearly 14.5 is relatively high compared to many industry averages, especially for a company showing only modest revenue growth right now. What it tells you is that investors are willing to pay almost $15 for every single dollar of revenue the company currently generates. Yeah. Now, that's not automatically a bad thing, especially for high-growth tech companies where massive future scaling is expected. But it definitely signals that a lot of future growth, a lot of future success is already baked into that stock price.
It's priced in, yeah.
It's priced in. The market is highly anticipating that BigBear.ai will grow substantially and, crucially, become profitable eventually. If that growth doesn't happen as fast or as strongly as the market hopes, that valuation could really struggle. And without something like a discounted cash flow, a DCF model, which tries to estimate value by projecting future cash flows, it's incredibly difficult to pin down a true intrinsic value for a company like this, especially when they're not yet profitable. We're relying much more on market sentiment and growth hopes than a clear path based on current earnings.
Okay, so the fundamentals show this tricky picture, challenging financials, but strong future potential. But what about the market's pulse right now? For a lot of investors, this is where the rubber meets the road. The technical analysis. What are the charts, the indicators telling us? Where might the stock be heading in the shorter term?
Yeah, the stock price has definitely seen some significant action lately. It jumped up, 15.45% on July 17th, 2025, hitting $8.22. But since then, it's seen quite a bit of volatility. There's been a drop. The stock is overall highly volatile. You see these large daily price swings, and it has a really high beta of 3.21.
Beta of 3.21. What does that mean practically?
It means it moves significantly more than the overall market. So to put it simply, if the S&P 500 moves up or down by 1%, BigBear.ai stock could easily swing by over 3%, either way. That signals potentially amplified gains, but also crucially amplified losses. It's definitely a higher risk, potentially higher reward kind of play that requires, well, a strong stomach for those market swings.
Given that high volatility, that high beta, are there any key price levels that the technical analysts are watching, areas of support or resistance?
The analysis we reviewed points to key support levels around $7.27 and then lower down to $5.46. These are price points where, historically, the stock has found buying interest. They acted as potential floors where a bounce might happen. So if it breaks below those levels, that could signal more downside is coming. But if it holds, that suggests there's still underlying demand at those prices.
And what about those common technical indicators people follow? Things like moving averages or momentum signals like MACD. What are they flashing right now?
This is where it gets a bit mixed. which can be really tricky if you're trying to read the technical tea leaves. The stock has actually gotten buy signals from both its short-term and long-term moving averages. That generally suggests upward momentum based on the recent price trends.
Okay, positive on the averages.
But at the same time, a sell signal was issued from the MCD, that's the moving average convergence divergence. The MACD is more of a momentum indicator, and a sell signal there typically points to potential short-term weakness, maybe a shift in the trend downwards.
So mixed signals then.
Exactly. Longer-term trends may be looking okay based on averages, but a shorter-term momentum indicator is flashing caution. It presents a pretty complex technical picture right now.
Okay, moving beyond the numbers in the charts, has there been any significant recent news? Or maybe insider activity, buying or selling, that's either flown under the radar or sent a clear signal about BigBear.ai?
Interestingly, no. The sources we looked at didn't really flag any major breaking news recently or any significant insider buying or selling that would grab headlines. Sometimes, no news is just no news. Suggests a bit of stability perhaps, but also no immediate external catalyst pushing the price one way or the other. However, that broader analyst sentiment, the optimism around the growing defense tech sector we talked about, that continues to be a positive undercurrent. It's likely still contributing to that overall strong buy rating. It really means the market focus seems to remain on the long-term story, not necessarily immediate headlines.
Right. What about upcoming events then? Any big potential catalysts on the horizon that could impact the stock? Anything investors should be watching out for?
The next really big thing to watch is their earnings report. That's scheduled for August 11th, 2025.
Earnings season.
Exactly. That will be a really significant moment. It could either confirm those optimistic analyst views or maybe challenge them, if they show stronger than expected revenue, or maybe hint at a clear path towards profitability, even if it's still a way off. That could give the stock a major boost. On the flip side, if it's just continued large losses without clear signs of progress, that could definitely dampen enthusiasm.
Makes sense.
Beyond that, there wasn't any specific information in our sources about, say, imminent major product launches or any big merger and acquisition activity. So that earnings report really is the next key focus point.
This brings us to a really important question, especially for a company profile like BigBear.ai's. What are the main risk factors, the things investors absolutely need to keep front of mind?
Yeah, if we try and connect all the dots here, you can see several layers of risk, and they're all pretty significant. First, you've got the stock-specific risks. We've already hit on the high volatility. Small market shifts can cause big price swings in BigBear.ai. And then, of course, those significant financial losses. The company's burning cash. Until it hits profitability, it's going to remain dependent on outside funding, which, as we said, could mean more debt or share dilution. For investors, these are very direct, very tangible concerns.
Okay, so risks tied directly to the stock and the company's finances. What about the broader environment they operate in?
Right. Then you layer on the sector-specific risks. The AI market, yes, it's booming, but it is incredibly competitive. Innovation happens fast. A new technology, a new approach could potentially disrupt existing players. And maybe even more importantly for BigBear.ai, that heavy reliance on U.S. government contracts.
Yeah.
That makes them highly exposed to any changes in government spending priorities or defense policies. Defense budgets can fluctuate based on politics, and government procurement can be notoriously slow and complex. That creates uncertainty around revenue streams. And finally, you can't ignore the macroeconomic risks. A broader economic downturn, for example, could lead to tighter government budgets across the board. That could directly impact BigBear.ai's ability to win new contracts or even keep existing ones funded at the same level. It's really a complex web of interconnected risks.
Oh, let's try and bring it all together then. After this pretty expensive analysis, looking at the financials, the niche, the potential, the risks, what does this tell us about whether now is a good time to buy BigBear.ai? How do we weigh those very real financial risks against that compelling potential?
Well, based on everything we've looked at, BigBear.ai presents as, well, a compelling but definitely high-risk investment opportunity. Those significant financial losses, the current unprofitability, and that high stock volatility, those are undeniable red flags for many investors. You just can't ignore them. However, it also holds, substantial potential for long-term growth. That seems primarily driven by its unique, possibly entrenched niche within national security AI, and also by that continued optimism from analysts who are clearly looking past the current numbers to future possibilities. It really is a classic potential versus current profit kind of dilemma.
And if we had to put a rating on it, based on the sources we synthesized, what would
Right.
that look like?
Yeah, the sources collectively seem to point towards a nuanced rating, something like a 6 out of 10. And that rating really reflects the balance we've been talking about throughout this conversation, doesn't it?
Yeah, it does.
It acknowledges that strong buy analyst consensus, which speaks volumes about the perceived future potential. But it heavily balances that against those very real, very significant current financial challenges and all those sector-specific risks we just outlined. So it's not a slam dunk buy, but it's certainly not a clear avoid either. It's somewhere in that middle ground, reflecting the uncertainty.
Okay, a 6 out of 10. So who would this stock actually be suitable for then? Is this something for every investor's portfolio?
Oh, absolutely not for everyone, no. This strikes me as a stock far more suitable for long-term investors, specifically those who possess a, shall we say, higher tolerance for volatility. You're essentially making a bet, aren't you? You're betting on the company's significant growth potential eventually translating into sustainable profitability. It requires patience. It requires a strong belief in the company's strategic positioning, that niche, to overcome these current financial hurdles. If you're an investor looking for, say, stable, predictable earnings or dividends, this is definitely not the stock for you right now.
Okay, so for those investors who do fit that profile, risk-tolerant, long-term view, is there a potential entry price range they might consider based on the technicals and maybe how they could think about managing that inherent risk?
Well, looking back at those technical support levels we mentioned, a potential entry range could perhaps be somewhere around $7 to $7.56. That zone is near those key support levels where the stock has historically found some buyers stepping in.
Right.
Now, in terms of managing risk, especially with such a volatile stock, thinking about a stop-loss order could be quite prudent, maybe setting one around that $7 mark to protect against further significant drops if support fails. And on the upside, if the company does start to execute, if it hits those growth targets analysts are hoping for, maybe a take-profit target somewhere around $10 could be a reasonable level to aim for to try and capture some of that anticipated upside potential.
Yeah.
But again, lots of ifs there.
So what does this all boil down to for you, our listener, who asked that initial question? Is now a good time to buy BigBear.ai? I think it means really understanding the full complex picture. You've got the exciting high-stakes potential of AI in defense and government on one side. But on the other side, you have very real financial challenges right now, very high market expectations already baked into the price, and that inherent volatility that comes with this kind of growth-focused but currently unprofitable company. It really comes down to making an informed decision that truly aligns with your own personal risk tolerance and your investment time frame. And that wraps up our detailed analysis of BigBear.ai for today. We've tried to explore everything from their financials and market position to that intricate web of risks and opportunities. We really hope this is giving you a clearer, maybe more nuanced understanding of the company that goes beyond just the headlines or the simple analyst ratings.
Yeah, our aim, as always, is really to equip you with the knowledge so you can connect the dots yourself. Understanding a company's past performance, its present challenges, and its future potential, especially in a dynamic sector like AI, is just so crucial for making decisions you feel confident about. It's about building your own conviction based on all the available data, not just following the crowd.
A big thank you for joining us on this exploration today.
And maybe just a final thought to leave you with. As you consider companies like BigBear.ai, or any company really where the valuation seems heavily tilted towards the future, ask yourself, how much of this current price is based on what they're doing now versus what the market hopes they'll do later? What are the hidden assumptions baked into that growth story? And honestly, are you truly comfortable with those assumptions and the risks if they don't pan out? It's definitely a question worth mulling over before you make any investment decision.
Absolutely. Until next time, keep asking those insightful questions and stay well informed.